I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and it's a pleasure to be back with you this weekend, giving you some of the latest what I saw in the market, what we have to maybe look forward to in the week ahead. Last week continued a lot of the rotation that we saw in the prior week and even a little bit into the week prior to that. It really all started with that June CPI report that was out on, I believe it was Thursday, July 11th. With that report, there's been a tremendous shift away from the large cap tech names, a lot of the big growth stocks, and money's been rotating more into value and into small cap areas. And I've got a chart that will illustrate that absolutely perfectly. I mean, the discrepancy between these areas of the market over the last 2 weeks plus has been pretty amazing. And usually when you see this kind of heavy rotation that lasts this long and has gone this deep, normally it's the start of something a little bit more spectacular that is likely to last longer term. So I've talked about small caps. I talked about them back at the beginning of the year. I said this was going to be the year of the small cap. I expected rates to be cut starting in Q2. They were pushed back, higher rates for longer. That was the Fed's new mantra. And as a result, the small caps kind of delayed things. But with that CPI report on July 11th, I think that was the signal, the message at that point from both the bond market and the stock market to the Fed. It's time. It's time to, start the cycle of rate cuts. I mean, this is what we need. This is what we're looking for. And this is what you need to do. And for those of you who maybe disagree with that, I would just simply say the Fed has two mandates. One is to stabilize prices, and the other is to maximize employment. And what we've been focusing on, what the Fed's been focusing on, is stabilizing prices. They said they wanted to see a sustained move down toward their 2% target. We were at 6.7. Now we're at 3.2. I mean, I think we're moving there. That seems to be a sustained move. We've gone down just about every single month on that annual rate for the last couple of years. I don't know what could be more sustainable. In the meantime, I talked about it yesterday in a big event that I had with our members over at Earnings Beats. I'm not so sure the S&P 500 is out of the woods, even if the Fed agrees to start cutting in September. I think they may have waited too long, just like they waited too long to raise. I think they may be waiting and may have waited already too long to cut. So I think the reaction to things coming up this week are going to be really important. We've got the Fed meeting, latest Fed meeting coming up Tuesday and Wednesday. I think the Fed should cut. I don't care if it's a big surprise or not. I think they should come out and cut. I don't think they will, but I believe they should. I believe they will talk more about cutting in September. I think they are going to say that we are making more progress toward our target. And of course, they're going to throw in this data dependent clause or paragraph or note or whatever you want to call it. But they're going to talk about cutting in September and how they keep moving in this direction because they want to be transparent. That's why I don't think they're going to cut this week because they haven't talked about cutting yet, not to that degree. They wanted to keep looking at data and so forth. So I think it would be a real shock to the market if they cut, although I think it could be a good shock. But instead, I think they're going to talk about how things are improving and how inflation seems to be coming more under control and that we're setting up for a potential cut in September. That's what I think is coming. Unfortunately, I don't know if that's enough. I don't know if that is enough to stop the slide that we've started here in the month of July. I think that we'll go through all the charts and I'll show you some things, but I do think we're going to struggle. If we're going to rally at all in Q3, I think it's going to be this next week, maybe the next 1 to 3 weeks. This is when I would be looking for a potential bounce. And I think the Fed, maybe depending on some of the things they say, maybe that will be what spurs the market. I don't know. But if they talk about rate cuts in September and the market sells off anyway, I think that could be a pretty clear signal that the market thinks they're waiting too long, that they've waited too late, too late to get things started to stop some of the deterioration in the economy. Now, I've had folks, write in and say, well, what do you mean deterioration in the economy? GDP quarter two just came in stronger than quarter one. You know, and you know, that's fine, except remember the stock market's looking at what's going to happen. GDP was what just happened. GDP for the quarter goes back as far as April, what was going on in April, May, and June. That's a far cry. If the Fed waits too long to start cutting, what happened last quarter is not likely to be what could happen in the next quarter. And that's where following some of these economic signs and signals that are currently coming in can provide us a lot of clarity as far as what may be transpiring in the economy. So what I will say is on Friday, we get the next jobs report coming out. Watch for the unemployment rate. Unemployment rate starting to trick up. And what I will tell you, not going to go into all the things we talked about yesterday at the event, but what I will tell you is unemployment, when it's on the rise, it is not good for equity prices. So if you see the unemployment rate just ticking up here or there here over the next couple months, that would not be good news for the market. Anyway, let's keep moving on. So the first chart I have for you, or the first slide, screen, whatever you want to call it, I put all the sectors, the 11 sectors, and then the 6 indices major indices that I like to look at, all in one chart list. So you can kind of see what's taking place over the past week. So I've got the S&P 500, I've got the Dow, I've got the NASDAQ 100, I've got the IWM, I've got mid caps, I've got the transports, plus the 11 sectors. And so 17 charts on here. This is set to the prior week. This is a 1 week look at what's happened in all these areas. And I want you to look at what's on top, number 1 and number 2. Small cap, IWM, mid cap, S&P 400 mid cap index. Those are the top 2. Then you go on XLU, XLV, XLB, XLF, XLI. I look at that, I think value. I look up top, those 2, I think small and mid caps. And essentially, folks, that's what is going on in the market right now. Value is leading growth, small caps, mid caps, leading large caps. I know that it was the opposite for a long time, but I'm telling you, there's a lot of money, a lot of rotation that's taking place. And this usually isn't just a couple, 1 or 2 week thing. Normally, when you see this kind of bifurcation, with small caps and mid caps ripping to the upside while you got large caps and many of the growth areas going down, that usually is a signal of something that's, developing and likely to continue. And so that's the way I'm approaching the market right now. But you go down further, then you got the transports, the industrials, real estate, staples, energy, and then you get the S&P 500, communication services, technology, NASDAQ 100, and consumer discretionary. So the 5 groups that really have been leaders, all of a sudden are on the bottom, and you look at all the areas that have been lagging, and they're all on the top. Market's been flipped on its head. And if you don't react to it or you don't respond in terms of your trading style, and you just keep doing what you've been doing, you could be in for some troubles. Now, again, I did say over the next 1 to 3 weeks, if we're going to rally, I think this is the time. I think some of these areas that have been beaten down might get one last hurrah before I think they go lower. Anyway, we'll get into all these different charts. Let's start off with the IWM. This is the Russell 2000. The bottom here, by the way, is the QQQ, which tracks the NASDAQ 100. I want you to look. This is what happened since the close on July 10th. That's what I'm looking at. IWM has been flying. We've gone from 203 and change on the IWM to 224 and change. That's 21 points. That's 10% roughly. We've gone up in the small cap arena for the past 2 weeks and 2 days. Look at what the NASDAQ 100 has done. It was at 502.50. Now it's at 462.50. So it has lost 40 points, which is about 8%. IWM up 10%. Large cap tech, QQQ, down 8%. That's an 18 percentage point swing in 2 weeks. Now, back at the beginning of the year, Market Vision 2024, when I talked about small caps having a big year, I said they were going to crush the QQQ. I said small caps would be up 50% this year. which at the time they were around 200, which meant they'd go to 300. Now, at this point, I'm doubtful that it gets all the way up to 300. I think we were a little later than expected getting started. It didn't happen in the second quarter. It's happening in the third quarter. So everything's kind of getting pushed back a little bit, but I do think that the IWM is going to see 300 by next year, sometime, probably early, first half of next year, I would say. So within a year, I think you're going to see at least a 33% move in the IWM. That's just my opinion. I think we're going to go through a series of rate cuts. That's going to open up lending in the small and mid-sized regional banks, community banks, regional banks. They're going to be in a much better position to lend. And who do they lend to? Small caps. That's one of the things, small caps with rates going up, it's been killing small caps. They can't compete and they can't afford. Many of the small cap companies have been losing money and borrowing's been difficult, expensive. And I think as that flips and we start seeing a reversal and that yield curve uninverts, which it's going to happen, probably if not the end of this year, it's going to be at the beginning of next year. We're going to see that inversion. I don't know what it's going to do for the large caps. I think we've got to kind of see how the economy evolves, but I think it's going to be a very, very solid thing for small caps. So this divergence that we've seen over the last 2 weeks plus, I don't know that it continues at this rate, but I do think you're going to see outperformance in small caps. S&P 500. Here, if you look, this is on a weekly chart. Look at the higher high with the lower PPO. Negative divergence here on a weekly chart. That could spell trouble for a while. One of the things I talked about yesterday at the event. NASDAQ 100 kind of already had a negative divergence, has already lost its rising 20-week moving average, which is now rolling over and trending lower, 20-day. This is a daily chart. And then broke down below the 50-day moving average. If we move to a weekly chart on the NASDAQ, you still see that same negative divergence, although it goes back to the 3 highs and 3 lower lows. Well, 2 lower lows on the weekly PPO. NASDAQ 100 went down, tested the rising 20-week EMA. If it fails to hold it, not intra-week, but if we get a close below, not good. That is not going to be good for technicals here over the next few weeks to a few months. IWM, opposite. Look, PPO coming off the center line. It was doing nothing, had no momentum. All of a sudden now, shooting through the roof, big breakout, got a nice little cup here. Maybe at the beginning of the week, I don't know, maybe we'll struggle. I wouldn't be surprised, though, if we just go right through 225. Really finished off strong last week. I expect to see further strength in the IWM. Okay, so we had our event on Saturday. With that, we had a webinar special, an event special, which allows anyone, a new member coming on board or even an existing member, to purchase an annual subscription and get 1 month free. So you're going to get an extra bonus month in addition to getting the, what you can get now is a recording of our Saturday event, along with a couple of bonuses, a couple of bonus chart lists that you'll get if you decide to become an annual member at Earnings Beats. So here is the landing page, and there are, a number of different just pieces of information about our service and what we do. And then all the way down at the bottom, there's a sign up page. Now, of course, the event's over, but if you do fill out this sign up page and become a member, you'll get a copy of the recording. And then you'll still have until Tuesday midnight to decide if you would like to extend your membership and get a couple of those bonus chart lists that I talked about. Really, all you need to do is just go to earningsbeats.com's homepage, and there will be an area where you can sign up for a no-cost trial, 30-day trial. And if you do that, you'll still get the recording and so forth. If you have any questions at all, write us at support@earningsbeats.com. Anyhow, let's keep moving. So with the small caps doing well, one of the things that we provided as another bonus for the event yesterday is I put together, if you look at the Invesco small cap sector ETFs, all of them are outperforming the large cap ETFs, the sector ETFs. All the small cap, every area outperforming the large cap right now. So what I did is I took the 9 sectors. So there's only 9 small cap sectors at Invesco, and we have 11 large cap sectors, the iShares. The difference is the small caps at Invesco include real estate and financial together, and they also combine communication services and utilities together. That's why there are only 9. But anyway, I went through these 9 sectors and made a chart list and added the top 20 components, the holdings, top 20 holdings in each of these 9 small cap sectors, and put them on this chart list. I have them ordered. So you can see the first 20 are all 001 XLK because technology, and then they're numbered in order 1, 2, 3, 4, 5, all the way down to 20. Actually, I'm not sure why that one's 19. Anyway, missing one mysteriously. I'm trying to think maybe if I counted. Oh, I don't know why this one's out of order. 20. All right, something probably in the way I typed it in. But anyway, here are your 20 technology stocks, small cap stocks. Last week, this is for a 1-week period, by the way, and how these 20 have done. Last week, technology was the worst performing sector, losing ground last week. 14 of the 20 components, the small cap technology components, 14 out of 20, 70% of them went up. Small cap technology didn't do that bad. It was just large cap technology. If we go down to the discretionary area, which starts with 002, XLY 001, 002, XLY 002, and so forth, you have them in order again of which ones are most heavily represented in each of these small cap sector ETFs. And I did that all the way down through the 9 sectors. So there's 20 in each one. That's 180 stocks. This chart list, I think, is golden to be using to consider trades off of in the near term. As long as that IWM QQQ ratio keeps going up, this is the chart list you want to focus on. Anyhow, anybody who's an annual member at Earnings Beats has access. We created this chart list, did the research, hold it all together, and literally, if you're a member at Stock Charts and you're also an annual member at Earnings Beats, you can click on a link, type in a password, and voila, 180 stocks in a chart list goes right into your Stock Charts account. You do need to be at least a basic member at Stock Charts, though. And by the way, I get nothing for you signing up at Stock Charts. We use their platform. That's why I encourage our members to use Stock Charts, but you can use any platform you want. It's just that if we do all this research and we provide these chart lists and you're not a member at Stock Charts, you can view the chart list. You can pull them up and view all 180 stocks, but you can't save them into your account. You can't scan against them. You can't, have a chart list, pull them up all in summary form. There's just a lot of tools that you can use at Stock Charts to better enhance your experience with this chart list. So do with that what you want. So I'm going to start with some of these, Mag 7 stocks. We know the small caps did well. We know Mag 7 didn't. But all of these, as you go across, are really struggling. I mean, I think all of them right now are trading below their 20-day EMA. So that's step one. That's not good. Because if you look, here's Apple. We were trending up above the 20-day. And when we're trending above the 20-day, which is above the 50-day, that's a pretty good sign. But what we're running into is Apple, you can see at the very top here, could not clear its PPO. So we had a slight negative divergence here. And now we're moving back down partly due to that. And we had slowing momentum. But the question is this the start of something bigger, or is it just going to be maybe a 50-day test and then back up? That we don't know yet, but I'm still watching for clues. I think further down Q3, I think we go lower. But I guess we'll see. Anyway, that's Apple. By the way, Apple, Microsoft, Amazon, and Meta, the first 4 charts I'm going to show you, they all report earnings this week, somewhere Tuesday to Friday. So there's Apple. Or actually Tuesday to Thursday on earnings. Microsoft. Now, I've had some people ask me questions about which of the large cap names, yes, they're getting beaten up, but which ones look the best for a possible rebound? I think Microsoft looks pretty decent. They're going to be reporting this week, so we'll see what happens with their earnings. You know, Google and Tesla reported. Google beat top and bottom line. Tesla beat top line. They did miss on the bottom line by a dime, but those reports weren't horrible and they still sold off. Google beat top line and bottom line and sold off. So it just could be buy on rumor, sell on news. And these stocks, even if they report good numbers, may not get as big a pop as you might think they expect, or that you expect they, should get. Anyway, that's Microsoft. Amazon trending lower. Look at that test of the 20-day and failure. That's not a good sign. Meta moving lower. Test of the 20-day failure. Not a good sign. Here's Google after reporting earnings last week. We went up right before earnings, tested the 20-day, reported great results, top and bottom line beats, and we gapped lower. Started moving lower. Not a good sign. Tesla moved up, was above its 20-day, was still in pretty good shape. Reported that earnings miss. Not as good a shape as it was before, although we got a big test probably coming up between 200 and 210, closer to 210. I'd watch probably around that 208 level. NVIDIA, if you want to know my honest opinion on which stock of these 7 still looks the best, it's NVIDIA, hands down. And they've got their earnings coming up in the latter part of August, and they typically have a very strong pre-earnings run. Now, in the midst of everything else going on and all these tech stocks going down, that's a tough call. I would be really shocked if NVIDIA doesn't get a rebound here pretty soon, just because. Now, here's a couple things that I look at on the chart. Okay, we've been struggling, we've been going down, but I see a lot of these moves to the downside with tails down below, meaning that they were trading lower in the morning. NVIDIA was trading down early in the day, but rallied in the afternoon. So there's still buyers out there. That's not been the case on some of these others. Look at NVIDIA's AD line. I mean, with 1 or 2 good days, we'd be back at an all-time high on the AD line on NVIDIA. So to me, it looks like there's accumulation taking place on this pullback. Also, look at NVIDIA relative to the semiconductors. It was leading when semiconductors were going up. On the pullback, it's just going sideways. That's the definition of a stock you want to own. A stock that outperforms its peers on the way up and then just kind of goes down alongside them on the way down. It's not leading to the downside. It's just kind of going along for the ride. I think NVIDIA is going to be the first one to bounce back. And again, I don't know if it's going to be in August, but August wouldn't surprise me because NVIDIA loves the second month of every calendar quarter. First quarter, February. Second quarter, May. Third quarter, August. Fourth quarter, November. Has a long time track record of outperforming significantly in those months. August 1st is this week. So, yeah, I think NVIDIA would be my pick out of all these that I think will be the first one to bounce back. And ultimately, if you said, okay, right now, pick one to own maybe through year end or through next year, it would probably be NVIDIA. All right, going back to the small caps. Now, I just showed you all those large caps, not really doing much, right? Actually doing something. They're going down. This is a completely different universe of stocks. These are 3 stocks that came off of that small cap ETF chart list I was just showing you, the 180 top holdings in the 9 sectors. Here are 3 of them. So here's one. This is Carpenter Tech. I mean, this thing's going straight up. It was 110 2 weeks ago. It's 140 now. There's ways to make money in the market, folks. It's just not with those large cap names right now. Next up, in the financial space, we've got Jackson Financial. A couple weeks ago, 72.5, 72, 87. That's a quick 20%. And how about, apparel retail? If the economy's going down, probably wouldn't be great for apparel retail. But here's a small cap apparel retailer that was in a very, very strong uptrade, kind of fighting the trend while small caps really weren't doing well. And then recently we had small caps take off, and this one actually went back to test support. See this breakout above 115? Came down, tested that, and then took right back off again. So anyway, I think Boot Barn looks good, but these are just 3 out of the 180 stocks on that chart list. There are a lot of companies that are doing really well at the small cap level right now. And if I'm right, and and the small cap index as a whole goes up 33% in a year, I think it could be more than that, but I'm just going to say 33%. What do you think some of these individual stocks are going to do? There are going to be some of these stocks that go up 100%, 200%, 500%. Some that have been beaten down for a long time that get new life with money rotating. I think this is an area you really, really want to continue to focus on. Now, last thing I want to mention, volatility index spiked last week. Here is a chart going back the last 3 years. You can see during the 2022 cyclical bear market, we had some outrageous readings on the VIX up in the 30s to around 40. But notice as we got out of that cyclical bear market and as we renewed our secular bull market, started trending higher in 2023 and 2024. Notice the peaks on the VIX. Every time we get a little weakness in the market, the VIX goes up, but it goes up to a lower level than where it's been. Now, I marked 2 key levels that I'm going to be watching. I think it's possible. I think it's probable that we're going to see a VIX hit 20 between now and the end of the third quarter. I think it's very possible that we get as high as 23 to test the high from October of last year. And it might be in October this year. But I think we go higher. And as a result, that's going to be accompanied with more selling to the downside and lower lows. So watch the VIX, but also, like I said, watch the rotation. Financials are doing great right now. Industrial's doing great. Healthcare, most areas, healthcare doing very well. Technology's been an area you wanted to be in for a long time because it's been a leader. It's 32% of the S&P 500, and it was going up. So the only way to outperform the S&P was to be in technology. Now it's the opposite. It's almost impossible to outperform the S&P if you're in technology because it's 32% and it's going down. It's been one of the weakest sectors. Last week, technology and consumer discretionary. There are a lot of technology and consumer discretionary stocks on the NASDAQ 100, on the S&P 500. And as a result, those 2 areas, along with communication services, if they continue to underperform, the S&P 500 probably has almost nowhere to go but down, which is why staying away from that and looking at small caps makes a lot of sense right now. All right. Anyway, that's it for me. I appreciate everybody tuning in. I'll be back next weekend for your next weekly market recap. It's been a pleasure. Have a great week, everybody. Be careful out there and watch that unemployment rate on Friday. Happy trading.